Hello and welcome subscribers to the Saturday Summary for July 19th, 2014, your weekly summary of market and economic news for annuity and life insurance professionals. Now our headline this week is instability, referring of course to the growing geopolitical risk in the world, but perhaps the headline should be insanity. This week has proven how disconnected the markets have become from reality. To me, this is now the Alfred E. Neuman market, of course an homage to Mad Magazine's mascot. This week saw the situation in Iraq continue to fester with no apparent resolution in sight. Israel launch a ground invasion of the Gaza Strip, and of course the Ukrainian crisis ratchet up with the tragic intentional downing of a passenger airliner. How did markets react? They rose. Other than a dip on Thursday as news of the Malaysian airliner tragedy hit the markets, on Friday, the trading computers bought the Thursday dip for a Friday gain in the S&P 500 index of over 1%, the NASDAQ gaining Friday over 1.5%, and the Russell 2000 index on Friday gained almost 1.6%. For the week, only the Russell 2000 posted a weekly loss. Now, as we see in our at-a-glance performance, with the exception of the Russell 2000 index, all the broad indexes are positive year to date. Now note that the yield on the 10-year U.S. Treasury Note has continued to languish, closing this week at 2.49%. That's a 17% drop since the start of the year and about 1.5% lower than at this time last year. But oddly, the national average 5-year jumbo CD yield rose this week to 0.83%, up from a stellar 0.82% it's been at for some time now. Now, much of the financial press was shaking its head in disbelief on Friday as the markets rallied in the face of what many consider to be the biggest geopolitical crisis since September 11th of 2001. At midday on Friday, the lead headline on MarketWatch's website was "Stocks are ignoring reality, rallying despite MH17." Of course, that was the flight number of the Malaysian plane. David Widener at MarketWatch opined, "The incident isn't just about the deplorable loss of 295 lives, it's about a new eruption in global terrorism, a critical moment between the United States and Russia, East and West. It is the most dangerous geopolitical moment since the financial crisis and the market crash of 2008 and 2009. Mr. Widener continued with, "The market seems to be saying, 'What global crisis?' He finished with, "When a market that, by a growing number of accounts, is overheated, keeps right on burning, that's a signal that the market has lost touch with reality." As I said, the Alfred E. Neuman market. Joshua Brown, who writes at the Reform Broker, opined, "So what we're discussing here is not a rise in uncertainty itself, but a rise in the awareness of that uncertainty and its subsequent effect on stock prices. And there is a notable rise in the awareness of uncertainty as I type. Events around the world are now in motion that, while not economically significant, could have a large impact on the investment markets. Whether they should or not is a question we won't bother with at present. But when geopolitical tensions flare and the investor class sits up at attention, the character of the stock market tends to change almost immediately." Now, meanwhile, the Fed is sending mixed signals to the financial markets. Fed Chair Yellen this week made statements to the effect that she thought that stocks were not overvalued other than certain small cap firms. Now, her words had a negative effect upon both the NASDAQ and the Russell 2000 indices that are real heavy in those small cap stocks, but really not much of effect. Meanwhile, Richard Fisher, a member of the Federal Open Market Committee, that's the guys that set interest rates, and the president of the Dallas Federal Reserve Bank, in a speech in Los Angeles, indicated in no uncertain terms that he believes it is time for the Fed to raise interest rates in addition to ending the QE stimulus. His speech, of course, had no effect at all upon the markets because the investor class still does not believe that the Fed will take the punch bowl away from the party. You can read more about that at the article on page 4 of the written summary. Now, big bank UPS weighed in this week with the release of a paper titled, "We Are Worried. We Reduce Risk for Now." Now, a quote from that UBS paper. "We read the market reaction last week to the Portuguese news as a sign that the market is indeed too complacent and could correct rapidly. We think the market is stretched. If this is true, the market is already pricing most of the potential good news in and is prone to react to the bad news." Now, this reference to Portugal is, of course, what we discussed in last week's summary. That was the default of Banco Espírito Santo on a big loan payment. Well, as an update to that, this week the holding company that owns that Portuguese bank, well, they filed for bankruptcy. Now, as part of that commentary last week, we introduced our subscribers to what we call the repo or the repurchase markets and what exactly it is that these money market funds invest in. Well, this week, USA Today joined us in that, and you can see their take on this at the article on page 9 of the written summary. Now, to me, this all has the feel of a western forest in a July drought. It won't take much of a spark to start a conflagration. If you are soon to retire, and you've done well with your market investments up to this point, and are considering taking that money needed to ensure your secure retirement to the safety of a protected and insured financial tool, I wouldn't wait too much longer. In this age of computer training, once the fire starts, it's going to spread quickly, and events this week have added more dry brush. Now, our featured quote of the week this week comes from President Richard Fisher, who in his speech on Wednesday, referencing the Fed's zero interest rate policy and QE stimulus, said the following. Here is the message. At some point, you cross the line from reviving markets to becoming the bellows fanning the flames of booming and bubbling. I believe we have crossed that line. I believe we need an adjustment to the stance of monetary policy. Now remember, subscribers, monetary policy means interest rates, and he is signaling an increase in interest rates, likely sooner than most of the market participants think. Now that's good for savers and safe money products, not so much for stocks and existing bonds. Again, more kindling in the dry forest. Well, that's your Saturday summary for Saturday, July 19th of 2014. Have a great weekend. We look forward to seeing you next Saturday.